Welcome to the Skilled MBA Finance Case Study Series. In this edition, we explore the growing impact of green bonds in climate finance. Green bonds have become a powerful tool for channeling capital toward environmental projects, from renewable energy and energy efficiency to sustainable infrastructure. These instruments enable investors to pursue both financial returns and sustainability goals, creating a critical bridge between capital markets and climate action. This case study unpacks how green bonds are structured, the key stakeholders involved, and the trade-offs between financial performance and climate impact, making them a vital component in the global push for a sustainable future. Climate change is the 21st century's defining challenge, demanding collaboration across governments, businesses, and financial markets. The 2015 Paris Agreement set ambitious goals to mitigate climate impacts and transition to a low-carbon economy. Achieving the 2020 targets necessitates innovative funding mechanisms to mobilize capital on a large scale. The Paris Agreement's 2020 targets aim for a 20% reduction in carbon dioxide emissions, a 20% increase in renewable energy, and a 20% boost in energy efficiency. Achieving these goals demands innovative financial solutions, such as green bonds, to mobilize the necessary capital for this global transition. Green bonds are fixed-income instruments aimed at funding climate and environmental projects. Governments issue sovereign green bonds for national climate initiatives and infrastructure. Development banks use them to finance sustainable development in emerging economies. Corporations leverage green bonds to support internal sustainability transitions and green innovation efforts. The green bond market has expanded over 17 times since the Paris Agreement, reflecting significant growth. However, it remains a small fraction, under 5% of the global bond market. This highlights both the progress made and the potential for further development in sustainable finance. Investors face the challenge of aligning environmental, social, and governance (ESG) goals with attractive returns. This dilemma questions traditional fiduciary responsibilities, as green bonds aim to deliver both financial performance and positive environmental impact. Balancing these objectives requires careful consideration of risk, return, and sustainability metrics. Green bond investing presents challenges such as lower liquidity, with thinner trading volumes and wider bid-ask spreads. Limited issuer diversity leads to concentration risks, while higher due diligence costs arise from verifying environmental credentials. Additionally, the potential greenium may result in lower yields compared to conventional bonds, reflecting increased demand for green assets. The greenium is the yield differential between green bonds and conventional bonds, reflecting the price for environmental benefits. Research indicates an average greenium of 1 to 9 basis points, varying by market, maturity, and sector. This differential is crucial for investors, especially institutions with strict return requirements, influencing their decision-making process. Green bonds have matured into mainstream investments, supported by standardized frameworks and enhanced liquidity. The European Union taxonomy and similar regulations have clarified definitions, reducing greenwashing. Investors now adopt nuanced approaches to environmental, social, and governance risks, yet knowledge gaps persist, with many still lacking a comprehensive understanding of green bond fundamentals and impact measurement. 76% of institutional investors view fiduciary duty as a barrier to environmental, social, and governance integration. Meanwhile, 82% of investment professionals anticipate green bonds becoming a standard in fixed-income portfolios within 5 years. This dual tension highlights the evolving landscape of green finance, balancing traditional fiduciary responsibilities with emerging sustainable investment opportunities. Green bonds are structured to fund environmentally beneficial projects, requiring certification and adherence to market standards. Their risk-return profiles differ from conventional bonds, often influenced by market conditions. Environmental, social, and governance integration frameworks guide the inclusion of environmental and social factors in investment decisions. The sustainability of green finance without regulatory support remains a critical question. Institutional investors face a dilemma, balancing financial returns with environmental benefits. Should they accept lower returns, and if so, how much lower? Transitioning green bonds to mainstream requires robust regulatory frameworks and market mechanisms. Impact measurement must evolve to offer precise data on environmental outcomes, enhancing transparency and investor confidence. India's green bond market is expanding, with 3,600 crore rupees issued in 2023, supported by government initiatives. The focus is on renewable energy and sustainable infrastructure. However, challenges like a nascent regulatory framework and limited investor awareness persist. Securities and Exchange Board of India's disclosure requirements aim to enhance market growth and investor confidence. Standardization in green finance is crucial, with frameworks and taxonomies converging to enhance comparability. Technology, like blockchain and artificial intelligence, is pivotal for improving impact tracking and transparency. As the market matures, integrating climate considerations universally in fixed income could align investor incentives, reducing the trade-offs between impact and returns. Thank you for joining us on the Skilled MBA Finance Case Study Series. Explore Skilled MBA's extensive library of case studies and courses tailored for finance professionals and Master of Business Administration students. Access resources that enhance your understanding of financial concepts and industry practices. For inquiries, reach out via mobile at +91 87553 00795 or email support@skilledmba.com. Visit our website at https://skilledmba.com/ for more information.